Brexit, the pin that bursts the London and Dublin property bubbles, question mark. Hi, I'm Marco Byrne, the Research Director of GoCore.com, your precious metal specialist. And today, unfortunately, many of you are going to groan and say, oh no, not Brexit again. But unfortunately, we do have to cover it. It's very, very important, obviously, particularly in the UK and Ireland, but also to the wider EU, and there's geopolitical ramifications on a global scale. And we think it's actually been very poorly covered in terms of the impact on financial markets and indeed investments. So it's an important topic, and there's been a lot of developments of late, both with Brexit itself and indeed in the markets. So what has happened with Brexit itself? Well, basically, we had the historic defeat of Theresa May and her Brexit proposal last Tuesday. And she is basically trying to cobble together enough votes in the UK House of Commons. I think she needs another 120 MPs to come over to her side, and also to get the DUP, quite a hardline party at the best of times, over to her side in the coming days before next, I think it's next Tuesday, January 29th, and I think that's going to be a very big ask for her, but that's what she's trying to do, and if she fails to do it, then other ramifications will likely include the possibility of the hard Brexit. And basically the UK is, the deadline for Brexit is March 29th. So we're very much, running out of time. And it's just uncertainty has gone up in quite a big way in obviously in the last week, and I suppose relations between the EU and the UK have. They're very poor to begin with, so I wouldn't say, I don't overstate things to say they've deteriorated significantly, but they're very, very poor indeed. And it was just today the EU came out, a senior spokesperson in the EU Commission came out talking about the UK needs to decide, tell us what you want, what you really, really want, which is they were sort of poking fun at the UK in terms of, that's actually a Spice Girls song, a very popular Spice Girls song, the UK girl band from the 1990s, and they're basically poking fun at the UK and Theresa May's government in terms of them not knowing really what they want and not being clear on that, and obviously huge divisions in the UK Parliament itself and within the Tory party, and indeed in the Labour Party and throughout the country. So it's not good, and that uncertainty is beginning to impact the UK economy as we long said it would, because uncertainty is not good for individuals, for consumers, for companies, and just for the economic outlook, because uncertainty is just makes people less likely to spend, and companies to hire people and to expand, and it basically slows down economic activity. They are not good, and when you start taunting a large nation using a Spice Girls reference, it's indicative of how bad things are in that regard and how bad the relationship has become. So let's look at some of the breaking news, the developments, and indeed the charts and the data regarding particularly the stock markets and the property markets, and we'll talk about that. Look, primarily UK and Ireland, but also there's wider global ramifications, and we don't want to over-egg the pudding and say Brexit is solely responsible for this. It's not. It's because the UK has a massive debt load at every strata of society, as does Ireland, as does much of the world. But I think Brexit is it's almost like the pin. It's just one more straw that breaks the camel's back, and it's creating huge uncertainty in both UK and Ireland and the European Union. So here we go. Brexit latest. Tell us what you really, really want. Europe turns Theresa May with Spice Girls quip. So, and there's a lot of that stuff sort of going back, and when that gets into the diplomatic channels, it doesn't bode well for a good Brexit outcome, shall we say. So, and it's huge uncertainty, and that's what we've been saying for months, that ultimately will impact the UK GDP, the UK economy, real world demand for goods and services, and indeed on the UK consumer. So Here we see just in the last few days, UK GDP growth is from last Friday. Car industry malaise drags down UK GDP growth to 0.3%. And they're saying Brexit fears are part of that, obviously. It's also a big slowdown in demand for cars, not just in UK, but actually internationally, which is a real bellwether of a slowing global economy. And basically, as we've looked at before, that the stock markets in 2018 performed very poorly indeed, and most major stock market indices were down 20%. Including the ISEC in Ireland, which is down 21%, because a lot of Irish companies obviously have huge exposure to UK, and a lot of uncertainty for those Irish companies. So it was down 21%, which is the worst performance since 2008. The performance of most stock markets internationally was the worst performance since 2008. That the height or the start of the worst financial crisis the world has seen in at least in the last 50 years plus, and possibly going back to 1929. So and the ISEC, so the Irish stock market was actually down 21% in 2018, so a very sharp falls indeed. And there's a real world consequence of this, obviously, in terms of, I think, roughly 250 billion, a quarter of £1 trillion were wiped off the value of FTSE listed companies, you know. And that means that investors, and they need pension funds, because a lot of these so-called balanced funds and diversified balanced funds are, you know, roughly, you know, 40-50% equities and bonds. So when you get very sharp falls like this, it means that the value of people's investments and pensions are dwindling in quite a significant way, you know. So the FTSE, it basically yeah, as I said, it was down 21% a year, and this is the long-term chart of the FTSE, and it's very interesting indeed. And you can see the bubble in here in 1999-2000, the so-called Nasdaq bubble, but it was much more than a Nasdaq bubble. As we can see, the FTSE and global stocks fell 30-40%, you know, and you can see there from roughly 7,000 at the top to 3,500, 3,600 at the bottom. Then we had the next bubble, which is obviously Northern Rock happened in 2007, and the UK economy was in bad shape. And then we had the Lehman Brothers, and we had the global financial crisis. And again, we went from, you know, 6,500, 7,000 back down to 3,500, so nearly 50% drop. And this is where we are quite recently. We got up to near the 8,000 mark, 7,700 plus. And we're down at 6,900. So the question is, you know, do we have another 50% retracement? And it's quite possible given the degree of uncertainty that's out there. So that's your financial assets, your stock markets, a lot of our investments and pensions in there. But it's also something that we've long talked about, is we feel that it will have an impact on property markets, because the London property market has long had many characteristics of a bubble. It's massively overvalued relative to wages and salaries of even very well-paid people, and it's become quite a speculative casino, you know. And prices have begun to fall in the last years, as we said they would. When Brexit happened in June 2016, we said this is going to have ramifications for both the economy and the wider property market, because the London property market was looking very toppy even at that stage. So property prices have gone down in the UK and indeed in London. And here's just headlines in the last few days. London house prices fall 1.5% in December as Brexit bites. So that's the 1 month alone there. Average asking price for London prices fell 1.5% in December. Property market suffered the slowest start in 7 years as Brexit bites. UK house prices rise 25% of value in wealthiest areas. So in wealthier suburbs, particularly in London, there's been a 25% fall in property prices. There's actually a higher fall when you go to the very top end of marketplace prices. In some houses are down 30-40%, you know. So London asking prices dropped below 600,000 for the first time. So you can see it's having an impact, as we said it would do, you know. And obviously property is a bit like cars. It's a bellwether, and it creates a huge impact on the psychology of the consumer and the investor. And rising property prices, people feel wealthy, obviously, because you know, most people have at least a family home, and many people would have more exposure to property investments, and buy-to-let is obviously huge in the UK as well, you know. So that uncertainty is, and that uncertainty is going to continue no matter what way we go. And I mean, obviously, there's a few different outcomes here in terms of the potential hard Brexit. Theresa May getting her deal through, it looks unlikely. You know, you've got your Canadian style free trade agreements. You've got your Norwegian style membership of the EU, which is sort of, they stay within the EU financial arrangements in terms of the customs union and that. But they could get out of the political side of the EU and the political apparatus. So that's another option. Another option is obviously the Swiss option, and then the other one is, and it's quite possible as well, is that they remain, because another referendum comes about, given the degree of political uncertainty. That is quite possible as well. And but if that happens, obviously it would be hugely divisive. I mean, they would be kicking the can down the road again, but I think there would be real ramifications for UK society, and the politics have become so divisive that you know, the country could become you know, almost unmanageable. You know, which would have, that uncertainty would have impacts on the economy as well. So none of the scenarios are pretty, are pretty, shall we say. They're all quite different, obviously, and some would mean more pain in the short term and less pain in the longer term, and others would mean less pain in the short term and more pain in the longer term, really. And but we're not going to get into that. We might look at that in the coming podcast, I think, because obviously it's going to be foremost in people's minds. It's important to consider it. So the London, I mean, when you look at even UK property prices, this chart is, I mean, it should, a picture paints 1,000 words, and I think any sort of investor who's reasonably sophisticated and realizes the cyclical nature of economies and the booms and busts, property does tend to go up over the long term. Absolutely. But when you see massive outsized gains like you see here, you do tend to see corrections, and sometimes you see quite sharp corrections. So this is where we're at. This is the average house price across the UK from Nationwide. And that chart just looks very, very tough indeed, given the uncertainty that we see facing the UK economy, the EU economy, Chinese economy, the US economy, and indeed the global economy. So I think, you know, the possibility that prices fall back down to the levels that we saw even in 2007, 2008, 2009, I think that has to be quite possible, and that would have, you know, very significant ramifications for the UK economy. Basically, it's not just London. This is from Bloomberg, got picked up by the Malaysian Reserve.com, a paper in Malaysia, and they're basically talking about London, New York City, Hong Kong, no longer immune to the housing slump. So no million bucks no more, a million bucks no more. Yeah, so Manhattan apartment prices have fallen below 1 million first time in 3 years. So it's, I mean, that chart in itself or table is not particularly dramatic, because in essentially prices are essentially flat for the last 3-4 years, but it definitely suggests that the New York property market is slowing down, and I think the trend is changing slowly but surely, and I think we're on the verge of quite significant price drops there, and Hong Kong, because there's a few of these markets, and we've long covered this. I'm not going to go into details of the individual property markets in some of these big cities, but there's a lot of them that have had very clear signs of being in a bubble, and they're beginning to correct quite sharply now as well. The little property market in Dublin, Dublin property prices are in many areas are back near the record highs they were seeing back in our bubble in 2008. The average house price would be still below where it was in 2008, but in Dublin 2, 4, 6, many prices are at or surpass the prices, and there's beginning to be questions asked about the outlook for the market there, and even the real estate agents themselves are basically saying that it's plateauing, and I mean, markets don't tend to plateau. Markets tend to go up and down, and property markets even tend to you know, you have peaks and troughs, and you rarely get sort of a flat line. And I think, given the degree of uncertainty that we've talked about, and the risks in terms of the level of debt of every strata of society, both in the UK and indeed in Ireland, obviously, that I don't think we'll see a plateau. I think we'll see quite a significant correction. And momentum is a very powerful thing, as we discussed before, as is investor psychology, and that's beginning to change. So latest figures from the CSO show the rate of house price increase slowed. Well, that's not particularly significant in itself, but it's more anecdotal stuff that the market is. Transaction levels have slowed down. The psychology is definitely changing. We have a estate agent there saying that the market has reached a plateau. So And then, yeah, as I said, when major global housing markets slow down, it's going to have a ripple effect on the national economies and indeed on the global economy. And this is an interesting article talking about, again, it focuses on the bigger cities, but the wider ramifications for all our economies. So, yeah, I mean, we've said this would happen. It doesn't give us any pleasure for us to say we said this would happen, but it was quite clear it was going to happen. In the same way it was clear in 2005, 2006, when we were warning last time that a financial crisis was coming. So it's coming. So what should you do? It's diversify. Don't have all your eggs in one basket. I think it's a great time. You know, when you see what happened to the FTSE and stock markets last year, it's a great time just to rebalance portfolios. Because, you know, if you have exposure to stocks and bonds and significant allocations to stocks and bonds, as most pension owners do, you know, you've had a massive run. You know, these assets have been at all-time record highs, and it's a great time just to reduce your allocation to these assets and allocate to cash and to gold. And I think if you do that, you'll be protected from these various worst case scenarios in terms of financial crashes. But even if we don't have the worst case scenarios and we have just a common gardener bear market as we tend to have in financial assets, and we see the corrections that we saw in 2000 and 2008, I mean, you know, those 40-50% drops, and that was in the S&P 500 as well in the US. So yeah, and gold has tends to have an inverse correlation over the medium and long term with these risk assets. So yeah, hate to be the bearer of bad news. It doesn't make us popular. We do feel that the media isn't joining the dots of the ramifications of Brexit in terms of obviously the geopolitical risk to the European Union, the financial, economic, and investment risk. You know, there's a lot of talk about the risk to companies and all that. And the companies need to prepare for Brexit, but no one's talking about what investors should be doing to prepare for Brexit, and they need a plan B, and part of that plan B should having owning physical gold in the safest ways possible to protect against these risks. And one of the risks is actually sterling is obviously very vulnerable. It's had sharp falls already, and gold has gone up quite significantly in sterling terms in recent years. And indeed, it was up about 3.5% in 2018, gold and sterling terms. And we think the EU and the euro has significant exposures, not just with regards to Brexit, but obviously in terms of German banks and Italian banks and Irish banks, and all these unresolved issues that we kicked the can down the road with. So, yeah, don't panic. Don't be afraid. Don't be scared. You know, we just believe people just need to be prudent, get on with their lives, do what they do, but just be cognizant of these risks and diversify your portfolios. It's quite simple. And gold is a safe haven asset and will protect people again from the various risks that are building all the time now. So thanks for your time. Yeah, if you have any questions at all, feel free to contact us, and you can follow us on all the usual channels. Yeah, thanks for your time. Take care. Bye-bye.